Hey everybody, Smart Silver Stacker here. Hope you're doing well. Saudi Arabia and OPEC Plus just announced that they're cutting another 1 million barrels per day of oil production. And they've also announced that they're going to be maintaining existing cuts until at least 2024. And that includes the 500,000 barrels of oil per day that Russia cut from their production earlier this year. Now, all of this has a significant potential to raise energy prices around the world throughout the rest of 2023, and that could lead to a resurgence of much higher inflation here in the US. And of course, that could have a big impact on the price of the precious metals. So we're going to get into all of that in today's video. And I also want to comment on some of the most recent developments regarding Saudi Arabia and BRICS. So stick around. Did you know that SD Bullion is giving away a monster box of 2023 Silver Eagle coins? Sign up for a chance to win today at sdbullion.com/sweepstakes. Now, if we take a look at the most recent CPI numbers, those are from April from the BLS, the Bureau of Labor Statistics, we can see that inflation is reported at 4.9% year over year. And then if we take a look at the one-year chart of crude oil, we can see that a lot of the decline in inflation that we have witnessed, it has coincided with the declining price of energy. And this makes sense because oil is the most important commodity in the economy, no doubt about that. The price of oil, it has a trickle-down effect on almost every other aspect of the economy. And that's either because petroleum is a direct input, a direct component of products or services, or it's because the cost of transportation or any of the other various energy inputs that go into just about everything that we buy. But part of this decline in energy, it's been due to fear among investors of economic contraction and reduced demand around the world, reduced industrial activity, that sort of thing. Part of it also has been due to the release of oil from the Strategic Petroleum Reserve, which, by the way, that is ongoing because according to the most recent data, the SPR, it's declined by 9.5 million barrels between April 28th and May 26th. And with the SPR drained by nearly half from its peak levels, this is clearly an unsustainable method to control high domestic U.S. inflation. And according to the International Energy Agency's oil market report, May 2023, demand for oil around the world is forecast to rise for the remainder of 2023, reaching an average of 102 million barrels per day. That's a 1.3 million barrel per day increase over pre-pandemic levels from 2019. Now, a lot of this is driven by robust growth in China, India, and the Middle East. And now, with today's announcement of OPEC Plus cutting yet another 1 million barrels per day of production, we're approaching the second half of 2023 with rising demand and a shrinking supply. This is a recipe for higher prices. But what type of effect would higher oil prices have on U.S. inflation? Well, it's impossible to know for sure. Certainly an upward effect, but we can get an idea of this by taking a look at this chart of the sticky price CPI from the Atlanta Fed. Now, according to this chart, the greatest reduction in CPI has been part of what they refer to as the flexible CPI. This is the portion of the CPI whose components tend to fluctuate significantly, and this includes energy prices. That component of the CPI has fallen to a mere 1.9% year over year. And think about it, that is even lower than the Fed's 2% inflation target. But the sticky CPI, these are the prices that tend to remain elevated once they go higher and they don't fluctuate a lot. You might call this structural inflation. This is driven by things like supply chain disruptions or an expanding money supply. These prices remain quite high. This aspect of the CPI remains at 6.5% year over year. So that flexible CPI, that is why we have had this disinflationary period, this decline in overall inflation levels. Now, if oil prices take off, well, that is going to move right back up. The flexible CPI will skyrocket. And if you combine that with the persistently elevated sticky CPI, that's a recipe for very high inflation indeed. So what does that mean for the economy and also for precious metals? Well, right now, the Fed, they seem quite confident that this decline in inflation that we have witnessed is going to last. It's going to continue. In fact, they're even talking about skipping the rate hike at this month's June FOMC meeting and possibly even skipping a rate hike in July. Now, it is interesting to me that they're using this term skipping in their recent statements, as opposed to the term pause. The implication being that they have not stopped hiking, or possibly we might interpret this that they have paused, they know that they have to pause the rate hikes to avoid a financial crisis, because remember, this year, we've already had bank failures exceed the 2008 financial crisis in terms of the value of deposits that were affected. So, the Fed may have an inkling that they have to stop hiking rates to avoid collapsing the banking sector and the broader economy. And the reason they're using this term skip is because they just want to act as if they are skipping and not pausing, that they're going to get right back to those rate hikes. Because, the Fed, they don't think that inflation is a result of expanding the money supply or massive deficit spending. They think it's just perceptions that drive inflation. They think that, if they're careful with their word choice and, they're always trying to jawbone the market in the direction they want, that they can control inflation that way. And to be fair, possibly in the short term, the perception control, it probably does have some impact. Just look at the way the markets react to Jerome Powell talking. They hang on every word that all of these Fed officials speak. But to the extent that this perception control does work, it means that the real drivers of inflation, disrupted supply chains, de-dollarization, massive debts and deficits, which, following this recent debt deal, by the way, are only going to get much worse, and also the massive expansion of the money supply in the Fed balance sheet, and soon much higher energy prices, which are sort of a knock-on effect of all those other things. All of these factors, they're going to have an even larger effect once market participants realize that the Fed is full of hot air. And if we see rising inflation for the remainder of 2023, if we see those numbers start to creep back up, if the CPI begins to rise, and if the oil price starts to rise, and along with that, the price of just about everything else, that moment when market participants realize that the Fed has lost its inflation fight, that it was doomed to failure from the beginning, that moment may be just around the corner. Now, I've talked many times on this channel before about how the Fed finds itself faced with an impossible choice. They either must defend the purchasing power of the US dollar by hiking interest rates, or they've got to bail out this over-leveraged US economy by returning to a much more accommodative monetary policy, by slashing rates, and by buying up more US treasuries to infinity in a massive binge of quantitative easing in which we see their balance sheet, go to the moon. And a soaring oil price, it could create an inflationary environment where that tough choice finally has to be made. And, just tell you this, historically, governments and central banks, when they've been faced with this type of a dilemma, with this type of choice, they almost always choose to inflate the currency away in an attempt to maintain the status quo. And of course, nothing in this video is financial advice, but if the Fed is forced into a corner like that, what asset do you want to be holding? Dollars in a U.S. bank, stocks, U.S. treasuries, paper assets, ETFs? I don't know about you, but as for me, should that scenario play out, I feel most confident in holding physical precious metals, these assets that have withstood economic collapse and hyperinflations time and time again throughout history, and which have served as stable stores of value for thousands of years. Now, we have another massive catalyst that is approaching that could drive a much higher US dollar price for oil. It's right around the corner in August. We just had top diplomats from the BRICS nations wrap up a meeting in South Africa attempting to lay the groundwork for the BRICS 2023 summit, which is going to be taking place in August. Now, by the way, this is an interesting development. This summit, which was originally set to take place in South Africa, it's looking like now it may end up moving to China or possibly Mozambique, apparently, because of issues with Vladimir Putin visiting South Africa due to an international arrest warrant for him, which has been issued. But at that meeting, It is widely expected that the BRICS organization is going to expand. They are going to be admitting new members, very likely, and this will include Saudi Arabia and Iran, some huge energy producers. Now, Saudi Arabia, they already just joined the BRICS New Development Bank, which includes other Middle Eastern members, such as the UAE. And this, I take this as a confirmation that they are going to be officially joining the ranks of BRICS at the next meeting. This is just another stepping stone on that journey. Now, once Saudi Arabia is in BRICS, it is quite likely that they may begin accepting currencies other than the US dollar for their oil exports. Now, we've covered this story as it has been developing, the end of the petrodollar, but really, this cannot be emphasized enough. And as it has played out, it seems more and more likely that this petrodollar ending event, it may take place soon, possibly even this year. Already this year, we've had China buying UAE natural gas via French energy giant Total Energy and paying for that natural gas in yuan. That's a key development in this dawn of the petro-yuan kind of scenario and the end of the petrodollar. We've had the Chinese and the Saudis, they've been hinting at this for years now, that Saudi oil could end up getting priced in Chinese yuan. And also, they've been deepening their energy ties significantly. China is the biggest buyer of Saudi Arabian oil, and the Saudis have recently announced billions of dollars of new investments in Chinese oil refineries. And now, if Saudi Arabia does join BRICS and they start accepting non-dollar currencies, whether it be yuan, rubles, rupees, gold, maybe a new BRICS reserve currency, that's also something which is looking like it might be on August's meeting's agenda. That means that all of the other OPEC nations will likely begin doing the same. And this would be a massive blow to the US dollar. It would significantly reduce that network effect provided by the petrodollar, this network effect where, everybody needs dollars to buy oil from OPEC, so it creates a massive organic demand for the greenback around the world. This could be coming to an end. And, what better time than once they're part of the BRICS group, which has always been more of an economic organization than anything else, to make this monumental shift in how they price their oil exports out of Saudi Arabia. And if that happens, well, we're going to be looking at not only much higher oil prices, but just the higher price for everything priced in US dollars, because the end of the petrodollar, the massive debts and deficits, the continued printing of money, and very likely soon to be the Fed capitulation, all of this means inflation is going to be moving much, much higher. And that is why I am still stacking gold and silver, getting my hands on hard assets to prepare for the devaluation of the currency. But I would like to know how you think this will play out. Could OPEC plus oil production cuts trigger a series of events which leads to the Fed capitulating in its inflation fight? Is the petrodollar system still going to be around in 2024? Leave me a comment down below to let me know what you think. Let me know how you are getting prepared for these eventualities. Or do you think that, all of this is an overblown threat? I'd like to get your feedback. Thanks for watching, everybody. Stay safe and happy stacking. I'll catch you next time. Smart Silver Stacker, out.